In this episode, Ray and I discussed the differences between IULs, or Indexed Universal Life Policies, and whole life policies. There's goods and bads to both products. Frankly, there's more goods with whole life than there are with IULs, but it depends on what you're looking for. If you're looking for banking, dividend-paying whole life policies is where you want to be. But we take the time to kind of explain why that is in this episode. Hope you enjoy.
Fundamentally, I think of it as a philosophy and a strategy to a degree. If you can get past your philosophy, in that, do you want certainty and protection and certainty and growth and all of that, and to shift the risk to the insurance company, and all you're responsible for is to make the premium payments, be it whether they're annual or monthly or whatever you decide. The same thing occurs with the IULs. I guess you can pay monthly or annually or whatever. But I think it comes down to philosophy. What is it that you're really after? And if you're after a combination of as you said, they categorize it as whole life, which it just seems so wrong.
They categorize it, if I may, as permanent life.
Yeah.
Right. And so it indicates whole life. Whole life can also be classified as permanent life. Really diving into the nuance there can be a little bit of an interesting study. But I agree with what you're saying. Is it comes down to philosophy. Ultimately, an IBC policy, a whole life insurance with a dividend-paying mutual life insurance company, that type of a policy is an awesome vehicle, and it provides so many great things we've already talked about in the episodes, and I know we're going to be continuing to talk about it probably in every freaking episode we even have. But it's just a vehicle, right? And I don't know, did you ever read Start With Why, Raymond?
Yeah, I have read that some time ago, so I don't really recall much of it, but I have it on my bookcase.
Cool. Yeah, so I like his philosophy this is Simon Sinek's book, Start With Why, and there's 3 concentric circles. In the center you have why, and then you have how, and then you have what. And he was saying that when we start with why, that informs the how, which informs the what. But so frequently, so many people attack problems by from the opposite perspective. They start with what, and then they figure out how, and then if they ever get to it, they'll discover why, right? Through the process of the what and how. Anytime we're talking about IBC policies, the policy itself is the what. Really, it without having that why and the how behind everything, it doesn't matter, right? And so if you're coming at it from a numbers perspective and all this kind of stuff, we're just looking at the what, and we're completely missing the how and the why and the how. The philosophy is found in the why, right? And that's what Becoming Your Own Banker addresses. That's what Nash was so focused on addressing, is changing your mindset to focus on why. What are you looking for? And you mentioned it at the beginning: risk mitigation and guarantees. Those are the biggest ones: risk mitigation and guarantees.
Yeah. And to go along with that, I think of, as you said, the why. Why? Because you want to alleviate all risk. Whole life with an IBC design, as I said, was passing all the risk on to the insurance company. They're on the hook, and they can't change things like you can. You can change things inside of it, but they can't change much. But inside an IUL, you have a level of risk that you take on. And I think of, why would you want to do that when you're really trying to protect, well, with IBC, you're trying to protect your family. You're trying to get cash flow growth. You can use it for the big events that happen in your life, or cars, or whatever it is. I wouldn't do that. What I understand about IULs, I wouldn't do that necessarily with an IUL, because things can change and the insurance company can change things. So there's unknowns, and there's unknowns in the IBC policy, except the unknowns is, what is the dividend going to be this year, and stuff like
That's like
that.
the only unknown. Yeah, it's like
That's like, right. And that's like the
and the
only
reason
unknown.
why that's unknown, just for our listeners really quick, is
Yeah.
because dividends are a reflection of the profits of a company. So if the whole
Yeah.
entire world is in a really slummy situation, maybe the profits aren't as high as they were last year in a really booming market. Same thing with interest rates. Interest rates can fluctuate year after year within the insurance company, but everything's so marginal. It doesn't swing like the market does. There's just a few points here and there.
Right.
But really, outside of that, like you mentioned, it's a unilateral contract with a whole life policy. As long as you pay your premiums,
Right.
they can't change anything. That's
Yeah.
cool. Like, there's no
Yeah.
changes.
Right. Yeah. And it's a private contract between you and them. And you have full control. Like, you can do, these things. You can do dividend paid up. You can do reduced paid up if you decide you don't want to pay any longer, past a certain time. Those kinds of things. You're in charge of those things. Whereas I just think of it as, I want something solid. Everything else outside of the whole life is risk. Everything.
Mm-hmm.
Doesn't matter whether you're talking about IULs or real estate or whatever it is that you're so-called investing in, starting a business. It's all risk. Jim Rohn said, "Hey, it's risky to get out of bed in the morning." Yeah, everything has risk, but this one thing is solid, right? And so if you design it properly, it can have a solid foundation, and obviously there's different ways you can design it. And sometimes the foundation might be a little small,
Right.
We design them so that this foundations can take on whatever happens
Yeah.
in the world. So, but
And
yeah.
you mentioned that there's no risk in the whole life. I agree when we're comparing it against when we're comparing it against everything else from an investing standpoint, the capitalizing of cash or capitalizing of an IBC policy, it's very risk free. But then you look into the fact that we are all human, and all of the companies that exist are operated by humans, and
Mm-hmm.
because of that fact, there are no real true guarantees that can, like, who knows, maybe we
Yeah.
get nuked, maybe, like, there's certain things that's like, yeah, there is a tiny element of risk, but when we're talking about there's no risk, what we're meaning to imply by that is compared to what, right? The other options
Good
out
point.
there, it's very difficult to have your cash value stolen from you. It's not quite as difficult to have your gold stolen from you. There's a risk in that. The ups and downs of the gold market, the ups and downs of the Bitcoin market, of every market, there's ups and the downs. But because of, like, if you listen to our previous podcast, we talked about the guarantees of the value of a policy. They're set. They're in that contract. And unless some act of God destroys, America, then, or, act of another
Yeah.
country
Yeah.
destroys America, that's not going away. Your contract is there. So it's a real safe place to be.
Yeah. Yeah. And inside the IULs, I mean, you can look all over the internet, and there's discussions on both sides of the fence. They're great.
Yep.
They're not great. If there's anything like that, any sense of this is going to be, could potentially become a problem, why would you want to risk the safety of your family? Meaning, you're trying to reach your human life value with a whole life policy. uh, via the whole life, and then maybe some added term that's convertible, possibly. But why would you want to put that at risk when, out in the IUL world, there's plenty of examples where people have lost all the money that they put inside these policies because the reoccurring annualized term inside the policy was not explained properly. Somebody pays a level premium for 35 years. The cost of that term inside the policy has continued to go up if it's an annualized one. And so somebody pays that many years, and then they turn around and they get a letter in the mail saying, "Hey, this is gonna go away here in the next year, unless you come up with this X amount of money." That's heartbreaking. I mean, I can't even imagine talking to a client, if you're still around, the agent that sold it. That would be heartbreaking to have that conversation.
Yeah. Yeah, no, that would be absolutely terrible. I would feel so bad. And I know some agents who have had to go through that process because they used to sell IULs. They're extremely marketable. And the reason
Right.
why is because they're investment vehicles,
Yes.
right? If we look at what kind of the history of IULs, the first universal life policy came on board in 1979. Okay, what else happened during that time frame? The stagflation, that ridiculously crazy inflation rates during 1979, 80, and all of a sudden ULs are on the market, universal life policies. I'm not saying they happen because of that, but anytime things happen in a really close to each other in a period of time, it makes me start to question, okay, well, why, right? And then um, then IULs came in, indexed universal life policies came on board 20 years later in 1997, right? So what history do we really have to look back at the security of these things? When you're banking, when you're establishing capital, you want to make sure that that's done right. And one way to do that, one way to know that something is solid, is by looking at history. When we look at dividend paying mutual life insurance companies, we work with companies that are over 100 years old. My favorite company has been paying a dividend since 1905. There's other companies out there that have been paying dividends since 1865. I mean, that means they've been profitable for 120 plus years. That's insane. And if that's the case, wouldn't you rather bet on that? And then yeah, it's just crazy. And then you look at IULs and they only have a history of 20 years, and yet you're wanting to build your future with them. Ooh, that gives me a little bit of concern.
Yeah, it should give people pause. Something new over here that looks to perform better because they illustrate better. Because of they're not in the market, but they're running alongside it, so to speak. Why? If this is the way I think of it, is if you're thinking you want to have higher gains, why don't you just go into the market? Why don't you just go in if that's what you really want to do? Now, somebody might say, well, but it doesn't come with a death benefit, and that would be true. I'd like to suggest start with a whole life dividend paying life insurance policy. And then once you have that going, if you still would like to try an IUL and want to be in the market and take a little bit of risk, and you have that capability, go ahead. I wouldn't pretend to do that. I wouldn't be the person to help.
And it's funny because we have, there's agents that you and I both know that talk about there being unrealistic size returns within these policies. Like they can be illustrated to show absolutely grand things, which is Fun from a marketing standpoint, but is that really best for the clients?
Right. Yeah, there's different caps. One of the one of the big things that you talk about with those IULs is or ULs is that there's a floor. A zero floor. So if the S&P doesn't perform, and it has a negative return in a particular year, you don't go below that in your print. You don't go below that floor that in your principal is protected, and that's not completely true.
Why not?
Because there's fees inside the
Exactly.
policy to run that type of design, meaning
So
that it's tied to it. So there's fees and expenses, and you don't know what those are going to be. It's so
are they
uh,
able to be changed?
yes, and so from what I understand, so are the caps
Hmm.
are able. If you miss one payment, everything can change.
But that's one of the things, the flexibility that the IUL advisors or agents or whatever you want to call it, that's one of the things they lean so heavily on is you can miss payments and you can make them up, or you can pay way more in the future than you're paying right now.
Yeah,
You can
yeah.
pay whatever you want to.
Yeah. So getting back to the beginning of our discussion, it really comes down to philosophy. What is it that the why,
Mm-hmm.
the what, and all of that. Really think about what it is that you're after, and go from there. Don't just say just because these things are performing so well. As an example, just the other day, a young lady called me, and somebody had been in her ear talking about how great these IULs are, and she knows my stance on it. And she said, "This guy wants to talk to you," and I was like, I'm not in a position to talk to him. I don't really want to do that. Not because I don't believe in what I'm talking about, but I just didn't want it to become a contest of who can yell louder.
Yeah.
And so she was overwhelmed by this guy's forcefulness and let him on the call. And he immediately went into the sales spiel. And I was like, that alone should put up a red flag to everybody.
Yeah.
Certainly did to me. As
Yeah.
soon as somebody's coming at you like you got to do this, that's a problem in my opinion.
Mm-hmm.
Certainly, I'm not comfortable with it, and there again, I and yourself included, I believe, we aren't going to fit everybody's parameters. Like
Right.
I'm going to have a certain type of personality, clientele that I want to work with, and they want to work with me. I can't be everything to everyone.
Mm-hmm.
And I think that's what the IUL world seems to try to do. And again, I say seems because I don't understand it 100%. I can tell you that most agents don't understand it 100%. They're being told how it works, and that's it. They aren't necessarily told all the little nuances and intricacies and all this stuff unless they go and start asking questions. And if they're captive, they probably aren't going to ask too many questions.
Right. You know what's funny is I have a client right now who's talked to a lot of different people and hasn't found an agent that is competent enough to understand this. And he's like, I've talked to people, agents that I've known, or with companies that should have that have good products. I've talked with agents at these companies and I say, this is what I'm looking for: high cash value life insurance, basically. Or he tells them infinite banking, and then they're like, oh yeah, high cash value life insurance. And then he proceeds to have a conversation with them, and um and then he stops talking with them because they don't know what they're talking about. Right? These are agents that sell whole life insurance, that sell high cash value life insurance, and they don't understand what they're talking about. And the reason why is because they don't have the philosophy behind it. The
Mm-hmm.
philosophy informs everything. Everything. And it's really
Right.
interesting because you can take the guy that you were talking with that you didn't want to, about IULs,
Yeah.
and yourself, and that's a lose-lose conversation. There's a reason why I don't really. I've had people approach me like, you should look into this IUL stuff. You should talk to these guys. It's really helpful. All this stuff, and I'm like, I'm not going to. And they're like, why not? You don't want to learn your industry better? I'm like, no, it's just I don't really want somebody to give me this spiel on all this IUL stuff. And because it's extremely marketable, it's extremely sellable, and they are convinced that it is the best thing for most people, right? And that's their philosophy. They believe with everything that they are that IUL is the best thing in the world. I don't. So they're going to be
Mm.
arguing with different rules than I'm going to be arguing with. So why would we even have the conversation?
Right. Yeah, because it becomes part of the noise. It's something that is
Right.
actually it's going to take up some of your very valuable time
Yeah.
with something that you understand to a degree enough that it doesn't fit into your philosophy. So why would I spend my time talking about it any further? Now, if there's somebody that has the mutual philosophy as you and I, and they want to talk about it, they just want to explain something. Hey, I'm all for learning a little bit more, but it isn't like that person is trying to change the way they're not trying to change my philosophy. They're just trying to extend a little education or a little understanding maybe that you didn't understand about it. And maybe that's helpful, maybe it isn't. So um, number one, I, I and yourself want to set people up with a solid foundation. To me, IUL is a fault line running right through it,
Mm, that's
and
a great way of saying that.
it's shaky. Yeah, that something changes, and there isn't enough cash value in that policy, you're going to get a phone call or a letter.
Hmm.
Please send X amount of dollars, or this will, uh, no longer be in force. So
Right.
that, as opposed to the IBC policy designed properly, you don't have any of that risk. And again,
Yeah.
if somebody wanted to go ahead and do the IUL later on after that, and they might compare, the time has a way of opening people's eyes. And what do they say when the tide goes out? You can see who's standing there without a bathing suit. You just never
Yeah.
know when that's going to happen. But I can tell you that it's going to happen because it's baked into our financial system. We're going
Hmm.
to have ups and downs. It's just the nature of the beast with fiat money all around the globe. So it's going to happen. And if it happens severely, which you can see out on the noise machine, um, it's not going to be like 2008. It's gonna, they've been kicking this can and so down the road for so long.
Yeah.
It's much bigger. So these IULs, when the can got kicked in 2008, thousands of IULs went underwater. Thousands of them. I don't know the exact number, but I can honestly say there were thousands, if not hundreds of thousands, went underwater. Um, I, and with the whole life, none of that happened.
Well, and that's so nice. That's we talked about this before in our previous episode, but the guaranteed element of the cash value within whole life insurance is when you're buying paid up additional life insurance, it comes with an immediate equity or immediate cash value based on a future death benefit, and you don't owe premiums for that anymore. It's guaranteed. It's yours. Like, you own it. That is a contract now. It can't go backwards, right?
Mm-hmm.
It can only go forwards because you're getting older and getting closer to that mortality, to age 121, and therefore your cash value is rising to eventually equal your death benefit at that point. Well, here's the problem with well, okay, before I dive into that, The other element of the whole life policy is you've got a level cost every single year for your whole life insurance. And you pick the schedule at which that's going to be paid up, whether it's 10 years or 50 years. I mean, there's everything in between. And with an IUL, the foundation of an IUL is renewable term. And what that means to folks who maybe are new to this concept is every single year you have to renew the contract, basically. And that renewal is based on your attained age. As you increase in age, you get closer to mortality. That means that you're at higher risk of dying. Every time you get a year older, you're at a higher risk of dying, which means your cost of insurance is going up. The insurance company is not stupid, right? They're not going to charge you the same at 60 years old as they did at 20 years old for that same amount of death benefit. So in order to maintain your death benefit and everything in there, you have to increase your renewable term premiums, right? Those are going up every single year. So when you were talking about the floor of an IUL, yeah, your cash value might be set at a certain floor, but then you have fees to operate all this. You have charges based on a bunch of different factors, and then you have increasing costs on the foundation of the entire vehicle, right? So even if your cash value stays the same, less of your dollars are going to pay for an increase in your cash value. Well, that happens a year, 2 years, 3 years in a row. Boy, I mean, that just racks up really quickly. And let's just say that, I mean, that's just a short dip and your policy was otherwise doing really well and you were funding it really well. Oh, as soon as something like that happens, you start to realize that there's nothing in here that's guaranteed, right? And oftentimes people take their cash value or they take values within their policy to pay those fees and those charges, right?
Yeah.
So if you're taking, if your value can't decrease because the stock market decreased, it can decrease because it's being used to pay fees, right? So you're depleting its values just to pay for the internal costs, which are always going up. How does that make sense?
Yeah, it doesn't. It doesn't make sense as a vehicle for stability and protection and solid growth, certain growth. Doesn't make any sense for that. But I'm just, some reason I like to play devil's advocate, but but just let's say that that IULs have a level term. Just hear me out. Say they had a level term. If that was inside of the policy that was moving around, meaning the S&Ps moving around and all that stuff, if it was a term policy for X amount of years, whether it's 10, 20, 30 years, that's all you're going to have the policy for, for whatever reason. But if it was a level term, what do you think the cost of that level term, if somebody was 30 and they can say, and they lay it out all the way out to 100 years, what is that level term going to cost that's going to be inside your policy forever? So if somebody said, well, there's term that is level, and heck, I don't know everything about IULs. All companies can design them any way they want. And there's lots of companies. So how do I know that there might not exist? If it exists, they have to charge you a higher amount in the beginning than they would normally have to do inside of a policy like ours forever.
Yeah, no, you bring up actually a really fascinating point and something I think that's worth mentioning, because whole life insurance is term insurance. It's just that the term is between now and when you die.
Yeah.
like between now and age 121. But you're not going to outlive that. And if you
Right.
do, you get the entire death benefit. That's what it says in the contract. So the term is for the rest of your life. As you shorten the term span from 100 years to 90, 70, 50, 30, 20, 10, and then down to 1, of course. Obviously, the chance of you dying within that term decreases every time you decrease the amount of years. So the length of term puts you into a certain mortality bracket, right? That puts
Yeah.
your age into a certain mortality bracket. The further you go out, the more likely you are going to die. The more likely it is that you're going to die within that term. Therefore, the cost of insurance must be higher. That's all whole life insurance is. It's the most expensive term life insurance, and it's guaranteed to be paid.
Right. Yeah.
Right. So
Yeah.
you'd basically at that point be buying a whole life policy, but if it's a level term that goes only to 100, then because term is rented and never truly owned, you wouldn't be building equity with every one of those premium payments. That's another great point. The foundation of these dividend paying whole life policies is something that you eventually own. You're scheduled to own it, right? To not have premium payments in the future. The foundation of IUL policies is the term element, and you can never own it. So you're not actually building equity with every one of your payments because it's not yours.
Yeah. Good point. Yeah. 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 When you get done with your, maybe your policy is fully paid up with the whole life, and it then you could look at it as an asset that it continues to grow past your payment time. And it seems as though the IULs, they don't do that. You are going to pay basically forever, one way or the other. I mean, either you're going to take it out of your pocket and put it in, or they're going to take it out of your IUL pocket and put it in.
Right.
Is that fair to say? That's what
I,
sounds like that's what they're doing.
yep.
It's almost like the forfeiture inside the whole life, right? If you can't make a payment, they can. If you take that designation, you want to forfeit out part of your cash value to pay the premium for a year or two. You can do that, keeps it in force, and you can then pay it back up again later on in the future. Maybe you lost your job, maybe something happened, maybe somebody gets sick, but it keeps going. But inside that policy, there's all kinds of fees, with the IULs, and that's not going on inside of your your whole life.
Most likely that's not going on inside of your whole
Most
life
likely.
because there are certain dividend paying or participating mutual life insurance companies that charge fees to use the riders. There's a charge to pay PUA
Mm.
in some mutual companies.
Yeah.
I don't like that. If there's an option to go with a company that doesn't charge you fees to use the riders that are making you money and all this kind of stuff, I would go pick those ones, right? And so again, that goes into company selection and all, just another philosophy set there.
Yeah. Yeah.
Um,
Yeah. So it all comes down, again, we're repeating ourselves, but it all comes
yeah,
down to philosophy and what it is that you're after. Why do you want permanent life? Why do you want whole life as opposed to UL, or why do you want a UL as opposed to whole life? Everything has to do with your philosophy. Everything in
right,
your life. It isn't just this. You're investing in the stock market. Maybe you have a broker. Maybe you do it independently. A philosophy about building a house. How do you want that? I like this feeling, or whatever. I want it to feel like this. I believe in this structure. That kind of thing.
right.
Everything starts with philosophy, and we aren't going to be everything to everyone in terms of having designed whole life policies for folks. And neither are IULs going to be everything for everyone either. It really comes down to what it is that you want.
Yep.
And it's okay to want.
And can I just ask maybe a rhetorical question?
Yeah.
Whole life insurance was created a long, long time ago, hundreds of years ago. Okay.
Mm.
IULs were created 20 years ago. Something was created in between those two times, and that was called the IRS. IULs happened after the IRS came on scene as an attempt to get through some of those loopholes and invest with tax-free gains, and have a side benefit of the protection on your life, the death
Yeah.
benefit.
Yeah.
Whole life insurance predates all of our tax IRS issues that we live in today. That separation right there is enough to cause you to wonder, like, why, right? And then the fact that IULs, or universal life, came on scene shortly after we got off of the gold reserve, during the hyperinflation state that we were in, and the MEC, the modified endowment contract, that comes in and says you can't treat life insurance like or whole life insurance like an investment vehicle, came on scene just a couple years after that. All of these things happened within an 8-year time period. That is, go study it, because there's so many things about that should inform your philosophy. And then I just want to read something from Becoming Your Own Banker, because this is where a lot of the philosophies are established for infinite banking, or not just established. Maybe people have these philosophies, they're just not clarified in their head. And Nelson Nash did an awesome job of bringing that to, or putting that on paper, I'll just say. On page 39, he says, universal life was nothing more than 1-year term insurance with a side fund of an interest-bearing account. It was an attempt to unbundle the savings element and the life insurance element of a whole life policy, something that cannot be done if one understands the concept of whole life insurance. And there's more there when he's talking about universal life and variable life and all that kind of stuff. There's more on page 39. But he specifically deals with it in Becoming Your Own Banker. And that was at the beginning, when the interest rates were really high. IULs were performing really well. Universal life was performing really well. And so it looked really good, but he wasn't persuaded. He wasn't caught by the excitement of all of it, because his philosophy was so grounded, and it was grounded in something that predates the IRS, that gives the most beneficial contractual terms to the owner. I just love that. That's the those are the shoulders that we're standing on.
Yeah. It was actually that event in the 80s when Reaganomics, what you're referring to is Reaganomics at that time. That's actually what really spurred Nelson to dig deep and pray for a solution, because he had been investing in land and in property and everything else, and he got caught. He was taking the advice of financial gurus at the time, and everything was working famously well. Everything was going along smoothly. He was doing really well. He kept doing bigger projects, all that kind of stuff. And then Reaganomics, and Ronald Reagan gets in office, and interest rates jumped for Nelson, as high as 21-22%.
Yeah, I think his 21.5 was prime, so it's 23% for him.
So all, like, overnight, pretty much, it probably felt like it was overnight that he went from doing really well to scared out of his mind. How am I going to be able to manage this? And all his friends that had been doing the same thing all filed bankruptcy. Everybody was filing bankruptcy, and he stood his ground and said, I'm going to figure this out. And then that's when it dawned on him, or maybe it was his brother that contacted him and said, you've got a bunch of cash sitting in these whole life policies. And he looked at him and he goes, because he categorized things, being a forester, he would categorize trees and all that stuff. So everything needs to be categorized. And he looked at these whole life policies. He says, we've been looking at these things all wrong for years, for a long time, right? All these agents go through the same tools, and he says, we've been looking at this all wrong. We should be putting as much money in to these PUAs as possible. Why don't the insurance companies open these up?
Mm-hmm.
And all of that. So it was Reaganomics that caused him to actually see this. And that, so there's always a silver lining, right?
Yeah.
There's always something positive. We were talking earlier that you were telling me about the different jobs you had and all of that. And I just say that is so, some of them were difficult,
Mm-hmm.
But I say, that's awesome. Even the ones that were not good and everything taught you something. And so Nelson was taught a valuable lesson. And then started the whole concept of becoming your own banker, started giving seminars and all. So that was the silver lining. And here we are today, all these years later, and we're still trying to get this point across. And the point really is, what is your philosophy? What do you want a foundation from which you can then take and invest in other things? Or do you just want to immediately go out there and start investing with no foundation under you if something goes wrong? And IULs are just, I just think that I've heard this from a couple of people that deal with high income folks, people that have capital. And they said, we don't deal with anybody on those IULs unless they have $20 million or more, because they don't have the depth of pulling themselves back from the abyss unless they have that capital in another location that they can therefore save this IUL.
And I guess my question to that would be, great, you've got $20 million. Fantastic. Why would you want to spend any one of those dollars pulling yourself out of an abyss that you got into because of the nature of a contract? Let's just say it did grow really fast, really early. Awesome. That's super great. Maybe you made some money on it. Why do you want to have to pull yourself out of something in the future? That's stress. That's loss of gains. That's there's just so many reasons why you wouldn't want to spend money just to save something. When on the other hand, you could create something that is completely stable and you'll never have to do that. Maybe it's not worth as much. Maybe it ends up being worth 5.9 million instead of 6.2 million, whatever. I have no idea. I'm just throwing things out there. Do you really want to risk that $300,000 difference? Do you really want to risk the unknowns of all of those fees and the future economy and all that kind of stuff just to get a meager 300,000? Let's just say it is $1 million. Is it worth the risk? I don't see how it is. Not when you're talking about all of the capitalization. If you're talking specifically about investing, fine. If you really want to do that, fine. But I would much rather capitalize and then go invest in something that has nothing to do with life insurance. Something that you know something about, right?
Right.
It's so convoluted.
Right. Yeah. So personally, I feel investments should stay investments and insurance should stay insurance. And you should have a balance between risk and safety, or risk and certainty. And in order to build wealth, and wealth can be many things, not just our financial wealth, but to have a balance between safety and risk, certainty and risk.
Right.
That's
And separate those.
that's a philosophy. It's just it's a philosophy. And there's two for me. There's all before even really digging into IULs, and I'll say I have not totally dug into them. I just don't want to spend the time because there's already so many red flags
Yeah.
that I can't honestly go down that road and say this is for you.
Yeah, that's a interesting point. There's so much that you and I both have to learn. Nelson never stopped learning, right?
mm,
And it was
mm,
his craft. He's the one that taught America and Canada. He's the one that really exposed all of this kind of stuff and added scale to it. He gave his life to this and he never stopped learning. So why would I go if I know something is really crummy like IULs and it doesn't fit the philosophical ideals that I have, why invest a ton of time in it? I I think that we
right.
should have a general idea to help our clients who are getting berated with this
Right.
marketeering information, but I don't necessarily think it's worth becoming an expert on.
Yeah. Right. Like a lot of things, right? You might have an interest in something just to know a little bit about it. Um, but you don't do deep work on everything,
Yeah.
you know. Purchasing life insurance within an investment just doesn't seem to make sense to me.
I like what you said. Keep a balance between risk and certainty, but don't put risk and certainty in the same thing
Yes.
because otherwise it becomes just risk. There is
Yeah.
no certainty. As
Right.
long as the risk touches the certainty, it takes away the certainty, right? And so,
Yeah.
yeah, I think that we all need to have a level of comfortability when it comes to risk. Like every time you wake up, it's a risk. Every time you get in your car, it's a risk. Every time you go to the grocery store, it's a risk. Every time you go to the theater, it's a risk. I mean, there's just risks. Our life is a risk. We're impermanent beings. So there's enough of that out there that you should take. I think everybody, no matter what their status is, whether they make $100 a year or $1,000,000 a year, $100 a year isn't enough, um, but if everything in between, set aside your finances that will provide you guarantees and certainty, and then go do the rest of the risk stuff of life, but
Yeah.
keep them separate.
Right. Yeah. Keep them separate. I want to say, for those that are listening, if you're listening and you have an IUL or a UL or a VUL, um, I want to say this. You tell me if it's wrong, but I want to say that if you would, if you would like us to take a look at to see what it is exactly that you have, you can send us, but you'll have to ask the life insurance company. If you don't have a copy of your contract, get one. You might have to pay a small fee for it, but if you do have one, scan it and send it to us.
Yep.
Also, you'll need to get an in-force current illustration. Send us that as well. Let us take a look at it and we'll explain what it is so that you know. We're not asking you to stop funding it and all that stuff, but so that we can explain to you exactly what it is that you have. And then you can decide what it is you want to do. And there are a number of things you can do, you know, if you want to keep doing it or if you want to change a little bit or whatever it is. But if it's helpful, if you'd like to know, if you're curious and you want to know exactly what you have, you'll have our emails below. Copy both of us, and we'll take a look at them. So I wanted to get that out and let people know that we'd be happy to take a look.
Yeah. And if you don't know what you have, if you don't know the contractual terms of what you have, there's a problem there. Your agent didn't take the time to make sure that you understood what you were getting. There's a problem there. Okay.
Right.
and I'm not saying we can't forget things. I forget things all the time. But if you're going through that contract and you're reading stuff and things don't ring a bell, whew, you should do a little bit of research. You should talk to us. You should talk to, I mean, if it's not us, talk to another agent who's kind of an expert within the IBC world, because I'll just go back to Nelson's quote. I think this is my favorite of his quotes. He always said, when you know what's going on, you'll know what to do.
Yeah.
Period.
Right. Yep. Very, very logical.
Yeah.
It's a truism. If you know it, you know what you know what you're looking at, you know what you have, you'll know what to do if you want to expand it or whatever else.
Yep.
But yeah, I think that's about all I have, Kyle. I don't know if you have more you want to talk about.
Yeah. Don't use IUL for infinite banking, and don't claim that it works.
Oh,
there.
Yeah. Geez, because you had asked about doing this today, talking about this, I just did a quick little bit of research and, pulled up some articles, and I saw that they said that people are using these as IBC policies, or they're being sold as IBC policies. You can do the same thing with these things. And I'm like, oh my God,
and
first off, any, the way I understand it, any practitioner that is part of the NNI, Nelson Nash Institute, has a sworn oath of not using these. Is that correct?
Yep. Yeah. It is. All of us, when we go through that practitioner program, there's a whole section on IULs, and it goes through all the positives and negatives, all that kind of stuff. And it says, they say it at the very end, as an authorized Nelson Nash Institute IBC practitioner, you cannot use IBC policies, use IUL policies for the infinite banking concept, and you cannot market them as IBC policies. So if anyone claims to be an NNI practitioner, an IBC practitioner, or they claim, even if they don't claim to be that, they're saying these are IBC policies, look again. Read Becoming Your Own Banker again and again and again until you understand the philosophy of it, because there's a huge gap between the philosophy of IUL and IBC and whole life. Thank you for joining us on the Sound Banking Podcast. If you're listening on YouTube, make sure to like and subscribe and click on the notification bell. Otherwise, join us on Apple Podcasts and Spotify for more content.